Hello, hope you're doing well. In this video, we aim to trade smart. This is the zero level needed for confirmation, called capital risk management. It's essential, like addition and multiplication. This zero level is crucial for all strategies. Let's get into it. You need a solid plan for smart money management. 2000 is not worth it because this is the zero that we need to confirm. That's what it's called. Risk management of capital title seems very boring. Like math class when I was a kid in high school. Now maybe it was more difficult, like repetition and things like that, but it really works, like addition and multiplication. This zero level is essential for all the strategies we implement with the conditions we set, whether it's robotic trading or whatever. I won't stress the importance of this topic any further, but let's move on. With any buy, with any amount of capital in any forex market, you won't see any of these strategies unless you have a solid plan. If you happen to watch my video, you're confirming smart money management, and we're not just going through the motions. If you don't follow this, you're gambling. If you're making money, you might think you're a good gambler, but that's not the case. Now, let's go to the chart so I can explain more. It makes a difference. Right now, let's assume I want to make a buy. If you don't follow this, you are gambling. If you are winning, you are making money. You are not defining yourself as a good gambler. Let's go to the chart so I can explain more. It makes a difference. Right now, let's assume I want to make a buy. Let's take a moment to look at the theory together, and then we'll come back. You've definitely heard this before. They say that if I have $1,000 in capital, I should risk 5% of my capital on each trade. What does that mean? There are two interpretations, and I'll write both down so you can see which one you prefer. If I have $1,000 in capital, I should risk 5% of my capital on each trade. What does that mean? There are two interpretations, and I'll write both down so you can see which one you prefer. One interpretation is that risking 5% of your capital means that 5% of $1,000 is $50. So I enter the trade with $50, meaning I bought $50 worth, for example. So that's one interpretation of risking $50, right? I made a purchase. Where should I start? Grab whatever technique you like. I don't know. Take whatever you want. Just make sure to analyze it. There's another method where they say to risk 2.5% to 5% of your capital. This means that if you hit your stop loss, you lose 5% of your capital. And that's exactly what we need, and it's correct. So if you hit your stop loss, 5% of your capital will be lost. And this is exactly what we need, and it's correct. Multiply your capital by 2% and 5% to get a number. Use this capital when stressed. Manage capital this way in all trades. Use this capital. Don't trade when nervous. If half your capital is gone, consider your strategy. This method identifies top 90% trading bots. You shouldn't open a trade. If half of your capital is gone, this method finds the best 90% of trading bots. Consider our team's 45 bot. With $1,000, for every 10 trades, you hit peak profitability. The first trade you make, Our team's 45 bot is truly amazing. Just imagine, if you don't follow proper capital risk management, what happens? Let's say you have $1,000. 90% means that for every 10 trades, you typically reach peak profitability with the bot. If you lose $50, you have $950 left. With proper risk management, you could achieve consecutive wins, boosting your capital. The point is, starting again the third time is significant. What happens to you? If you lose $50, you have $950. If you followed proper risk management, you'd have $950 left, and then you could hit 9 wins in a row, increasing your capital. Now, this point I'm making is that the third time you start again, but it's a significant outcome. If you don't follow this principle, what happens? You had $1,000. If don't do this, what happens? You had $1,000. You start with $500. To double it, you need a 100% return. Recovering from past mistakes often leads to new ones, distinguishing traders from gamblers. A 10% profit is $50, but without a big increase, it's risky. It's fun, but be cautious. You try to make up for the previous mess, but then you end up creating a new one. And that's the difference between a trader and a gambler. If you put in $500, yeah, if we make a profit, let's say you get a 10% return, that's $50. But until Zara gets it, for example, if it goes from 100 to 100, you could end up making $500, and that would be a lot of fun. But it's a double-edged sword, so what's on the other side? And that's what I want to explain in this video for you. I'm going to clear everything out. There are a couple of tools next to this virus that come up on the left side, which are the main position tools. You can also hit the star here to bring up a page for you. You can open any position you want in any market. Now, there are free tools available. Just click on them. Before you set your stop loss, click on it twice. From this section, you can specify your site's details. Your site can be any number, like $200. You have $1,000. This calculator calculates in percentages or dollars. I recommend using percentages. It asks how much of your capital to risk, 2% or 5%. If you hit a stop loss, you'll lose that percentage of your capital. It shows chips and more. Now, an interesting point. You can choose either by percentage or by dollars, but I definitely recommend using percentages. It asks how much of your capital you want to risk, 2% or 5%. What does that mean? It means if you hit a stop loss, you'll lose 5% of your capital, and if you hit a stop loss at 2%, you'll lose 2%. N is also hitting the chips and all that, but through this graphical relationship, you can visualize it. Now, I want to show you an interesting point. I said my account has $1,000. I told him, Hassam, I have $1,000 that I want to trade with. Now, the trade has gone bad. It's more than $1,000 or less than $1,000 and he's editing it. Pay attention, he said, if you get reformed, you will become an imam. 950. I had said that another 5% would go, meaning $50.5. If there's a correction, and it drops further, it should, right? Why not? I told him, avoid this. Where's the stop loss? I say 0. Wherever I set it, I should lose $50 if hit. He asks, how's that possible? What about leverage? I adjust up and down, but quantity stays. Stop loss sets volume, that's the date. When stop loss drops, quantity and profit change. Set stop loss anywhere. No need to worry about capital management. And the date changes. It says if we make a profit of $1,000, it will be $1,083. The quantity doesn't change. The stop that determines the volume is 9 a.m. on the date. When the stop loss goes down, both the quantity and, consequently, the profit change. So, proper capital risk management works like this. Now, you can set the stop loss wherever you want. You don't have to worry about capital management anymore. You lack risk management. Enter Tehran. Risk determines volume. What do you want to do with what volume unit? The peak is 40,322, so by 322, I have $1,000. The risk is limited to the volume. You enter the trade with this volume. That is, on the exchange, for example. If it connects, the protein stays. If set up in exchange, I want to trade. What volume unit? The peak is 40,322, so by 322. It doesn't specify price in tomans or dollars. It says $40,000.5. I have $1,000. Does leverage matter if it's 10.5 or 50? With proper risk management, your tools help. You can do what Bahram does with 2 or 50. Higher leverage means more free capital to work with. It says 40,000 to 2.5 boxes of crap. Now I have a question for you. Does it matter if the leverage is 10.5 or 50 or whatever? It really doesn't make any difference. And that's where the story gets interesting. If you follow proper risk management, your tools become helpful. You can do the same thing that Bahram is doing with 2. And we can do the same thing that Bahram is doing with 50. What's the difference? A higher leverage means more free capital to work with instead of just trading. If you take $100.50 Bahram, you get $10,000. If you take $10.50 Bahram, the dam opens up, and you create a quantity of $1,000 for yourself. The important thing is the volume you enter in the exchange. You can adjust the leverage in such a way that it matches the volume. This stop loss you set is based on this account in the exchange, and if you hit the stop loss, that's what happens. $950. This is the beautiful thing, so be sure to follow this. Watch the video 1 or 2 times. To help you understand, I explained this topic briefly. It doesn't matter if you're Iranian or foreign. It tells you the volume. You want to control it. For example, I want to take a sell position. I click on it, saying I have $1,000 or $100, and I want to risk 2% of my capital. When they move the stop loss, I set it. It says if you hit the stop loss, you'll have $98 left. I take 4 hits. I'm adjusting it. The Bitcoin quantity is going down. It says you entered with 0.005 Bitcoin. We hope to enter with 0.010 Bitcoin. It calculates how much you would lose if you hit the stop loss. If you stop eating, you'll get $98. I take 4 hits. Whatever I want to do, I'm adjusting it up and down. What's happening is that the Bitcoin quantity is also going down. It says it's fixed here. It says you entered with 0.005 Bitcoin. Now, we hope to enter with 5,000. We want to enter with 5.5, 0.010 Bitcoin. You want to enter with 100,000. We hope to enter with 5.5, 0.010 Bitcoin. It calculates for you how much you would lose if you hit the stop loss, and you need to keep this in mind. Follow this if you're using a robot. If defining with a Paris robot, the training was about trends. I entered the trade when it was rising. If I had followed proper capital risk management, I would have still hit the stop loss. Assume someone bought robots. The first signal was bad. Without proper capital risk management, their account would be shaken. This robot was given a book. We have an Islamic setup. The previous swing is below the cloud. Bought robots. Bad signal. No capital risk management. Account shaken. Robot given book. Training shows entry. Islamic setup. Swing below cloud. Not above cloud. Hit stop loss. There's nothing more to be done, but it was this robot. This same robot that was given a little book, meaning those who have seen the training know that we would have entered here. We have an Islamic setup now. The previous swing is below the cloud, whatever it is. Now, the fact that it's not even above the cloud, and we're not entering it, but something like this happened, and we hit a stop loss here. We hit a stop loss. I had $100. I had risked 5%. So now my account is at $95.5. Now I'm going to open a short trade here. I click twice and say I have $95. I want to risk 2% of my capital. I place it above the cloud. And for example, I enter a series of 3, 4, or 2, whatever the strategy is. And let's see what happens. Here, it calculated and I came back to $101 in profit. This is a beautiful thing that happens when you follow capital risk management in the long run. Just take a look. Now, here the signal has been good and his partner has been good too. Here, for example, there was an upward trend, but it should have been given up. They are counting. This one is eating the cake. This one is eating the card. This one is eating the crack. This one is eating the crack. This game has gone up to the level of being a flower. This one is eating the water. This one is eating the internet. To ensure a positive outcome, it's essential to have money in your account until the end. This is how you can confirm responsibility. Thank you for spending your time with us so far. I promise it's been worth it to stick with us. If you have any questions, you can ask in the support section of the website or on our Telegram support. We've also set up a signal channel where the signals from the bots are coming in so you can test the bots. This way, those who bought the bots can use the application more easily. In short, we really appreciate you. Much respect. In short, we really appreciate you. Much respect.